The 1929 stock market crash is often remembered as a single catastrophic moment, a sudden collapse that dragged the world into the Great Depression overnight. But history rarely moves that cleanly. What happened on Wall Street in October 1929 was not an accident, and it was not simply the result of panic or reckless gamblers losing control. It was the final act of a long experiment built on excessive optimism, easy credit, and the belief that economic growth had no limits. By the time the market finally broke, the damage had already been done. Years of debt-fueled speculation had inflated asset prices far beyond reality. Confidence, the most fragile pillar of any financial system, had been stretched to its breaking point, and once that confidence cracked, no speech, no policy, and no central bank intervention could restore it overnight. This is where the myths begin to fall apart. The crash was not one bad day. It was a process, a slow buildup of excess that made collapse not just possible, but inevitable. And if this story feels distant, a relic of ticker tape machines and outdated suits, it shouldn't. Because the same forces that shaped 1929 are deeply embedded in modern financial markets. The foundations of the crisis were laid during the Roaring Twenties. America emerged from World War I as the world's dominant economic power. Factories expanded, consumer goods flooded the market, and new technologies transformed daily life. Automobiles, radios, and household appliances became symbols of progress and prosperity. Wages rose, cities expanded, and the idea of permanent abundance took hold. But beneath the surface, the system was already cracking. Farmers were collapsing under debt as agricultural prices fell. Wealth became increasingly concentrated, leaving most households with little margin for error. Banks operated with minimal oversight, lending aggressively and speculating with depositors' money. The economy looked strong, but it was dangerously unbalanced. The stock market became the ultimate expression of this imbalance. Between 1921 and 1929, the Dow Jones Industrial Average surged from just over 60 points to nearly 400. Investing was no longer reserved for elites. Middle-class Americans poured into the market, convinced they were participating in a new economic era. Brokerage offices spread across the country, while newspapers and radio programs amplified the excitement. What made this boom especially unstable was leverage. Margin trading allowed investors to borrow up to 90% of the money needed to buy stocks. Small amounts of capital controlled massive positions. As long as prices rose, profits multiplied. But when prices stalled or fell, the same leverage turned lethal. Margin calls forced rapid selling, accelerating declines and feeding panic. The higher the market climbed, the more fragile it became. Even respected leaders reinforced the illusion. Bank executives, politicians, and economists publicly dismissed any risk of collapse. In October 1929, economist Irving Fisher declared stock prices had reached a permanently high plateau. These were not ignorant voices, they were authorities of their time. But collective optimism has a way of overpowering intelligence. When a system rewards risk-taking and punishes caution, denial becomes rational. Warnings did appear. The Federal Reserve raised interest rates in 1928 and 1929, attempting to slow speculation, but credit had already saturated the system. In September 1929, markets peaked. Large investors quietly exited. Confidence wavered. Then, in late October, selling turned into panic. On October 24th, Black Thursday, trading volume shattered records. Banks and institutions stepped in, buying stocks to calm the market. For a brief moment, it worked, But days later, on October 29th, Black Tuesday arrived. Millions of shares flooded the market. Prices collapsed faster than information could travel. Fortunes disappeared in hours. The illusion of endless prosperity was gone. Yet the crash alone did not create the Great Depression. It exposed weaknesses that were already there. Banks failed in waves, wiping out savings and freezing credit. Businesses collapsed as loans vanished. Unemployment soared. International trade imploded as governments turned inward, raising tariffs and abandoning cooperation. A financial shock transformed into a global economic disaster. Between 1929 and 1932, the U.S. stock market lost nearly 90% of its value. Entire lifetimes of savings vanished. There was no deposit insurance, no safety net. When a bank failed, everything inside it disappeared. Governments worsened the crisis by clinging to rigid policies, including the gold standard, which forced austerity during the worst possible moment. Countries that abandoned gold recovered faster. Those that didn't paid a higher price. The social consequences were immense. Economic despair reshaped politics across the world. In the United States, sweeping reforms attempted to rebuild trust in markets and institutions. Regulations, deposit insurance, and oversight emerged not from theory, but from catastrophe. And this is why 1929 still matters. The mechanics of financial bubbles have not changed. Easy money, speculation, and collective denial appear again and again. The dot-com bubble. The 2008 housing collapse. Each time the story sounds familiar. This time is different. The fundamentals are strong. Markets always recover. These phrases echo across generations, right up until the moment they fail. Modern markets are built on the same psychological foundation. Asset prices inflated by cheap credit, massive global debt, new speculative arenas powered by technology and social momentum. Once again, millions believe the system will protect them. History suggests otherwise. The true lesson of 1929 is not about fear. It is about fragility. Those who relied on leverage, debt, and blind trust were destroyed. Those who understood cycles, diversification, and real value survived. The difference was not luck, it was knowledge. So the question is not whether another crisis will happen. It always does. The question is whether you recognize the pattern before confidence breaks again. Because when it does, protection vanishes first, and the illusion of safety goes with it. The 1929 crash is not just economic history. It is a warning, a mirror, and a reminder that markets do not collapse because people panic. They collapse because people believe they never will. Please subscribe and support me to keep this kind of content coming. Goodbye.